Oracle just lost nearly 60% of its market value, yet Wall Street still expects the company to almost double its revenue by 2030. Think about that for a moment. A company expected to grow faster than ever is trading like its future is falling apart. So somebody is dramatically wrong here. Is the market overreacting? Or is Oracle quietly becoming one of the biggest value traps in the AI revolution? Today, we are going beyond the headlines. We are going inside Oracle's financial statements, its AI strategy, debt profile, risk profile, and the numbers that could determine whether this become one of the greatest infrastructure investment in technology history or one of the most expensive mistakes ever made. Free cash flow went negative. Debt exploded past $150 billion, and more than half of Oracle's entire future backlog now rests on a single customer. Oracle doesn't have a revenue problem, it has a financing problem. That's why it's one of the most fiercely debated stocks right now. Revenue is not slowing, it's accelerating. For nearly 50 years, Oracle was a reliable, profitable database company. That growth investors mostly ignored. Then the AI boom rewired everything. Every AI model needs massive data centers packed with GPUs. Oracle proved unusually good at building them fast and at enormous scale through Oracle Cloud Infrastructure (OCI). And last quarter, OCI grew 93%. For a company this large, that growth is extraordinary. But growth alone is not enough. The key question is why can't Amazon or Microsoft cross Oracle? Oracle owns something they don't, the core proprietary database system of the world's largest banks, governments, and hospitals. Switching is expensive, risky, and slow, and that's classic lock-in. Its autonomous database extends this into AI through its multi-cloud strategy. This mode should outlast the AI hype. Then came the game-changing Stargate partnership with OpenAI to build AI capacity at unprecedented scale. In a world of severe GPU and power shortages, the big clouds were largely sold out and hesitant to commit. Oracle stepped up with enormous dedicated capacity, fast delivery, and aggressive pricing. In a single year, Oracle spent more on data centers than it paid to acquire Sun Microsystems, NetSuite, and Kernel combined, three of its largest deals in history. Next year, it plans to spend even more. The real asset is not current earnings, it's whether OCI becomes the fourth largest hyperscaler alongside the Amazon, Microsoft, and Google. What the market is missing. So let's build the optimistic case properly. Start with the backlog. Oracle's contracted, not yet delivered revenue. It has raised $638 billion. To put that in perspective, that's nearly 10 times the company's entire annual revenue. And this is not a speculative capacity sitting empty. Almost every AI data center slot Oracle builds is already spoken for and running close to full capacity. Customers are prepaying Oracle and handing them over money Oracle never has to raise. So when critics attack the spending, the bulls have a clean answer.
Where do you go from here?
Well, we want to make sure we beat Amazon in cloud database.
This is Amazon in 2011, burning cash today to own the infrastructure that prints money for decades. And through the entire crash, management did not cut its long-term revenue targets. Instead, it raised them. And to be fair, management has earned some benefit of doubt. This AI pivot is simply the next attempt at that same transformation. Oracle is not being valued on the year's earnings. It's being valued on whether 2030 free cash flow ever actually shows up, which leaves the only question that matters. If everything looks this good, why has the stock collapsed? This is where the equity market and the bond market completely part ways, because that celebrated 638 billion backlog and estimated 54%, around 300 billion plus, tied to a single customer concentration risk, OpenAI, through a Stargate, one company that does not yet turn to a profit and stays alive by raising billions of fresh capital. And this is where things become dangerous. To fund this build-out, Oracle's borrowing has crossed $150 billion. The rating agencies now sit with a negative outlook. One more aggressive raise, and Oracle's debt stops being investment grade. And a downgrade to junk is not just a label. It forces some fund to sell those bonds automatically and raises the interest rate on the tens of billions Oracle still needs to borrow. The problem starts feeding itself. The bond market is screaming it. The cost to insure Oracle against default now runs 3 to 4 times higher than other hyperscalers. The credit market has stopped treating Oracle like big tech and started pricing it like a leveraged AI bet. Oracle generated a record $32 billion of operating cash flows this year. The business is clearly strong. So, how free cash flow turns negative? Here is the answer. Management spent aggressively almost all of the operating cash flow and then the tenth of billion of more building the data centers, and the free cash flow swung deeply negative. And here is a risk that has nothing to do with the OpenAI, and that's execution risk. Even if OpenAI performs exactly as promised, Oracle still has to execute one of the fastest data center build out in the history of enterprise software, on time, on budget, at gigawatt of scale. But under all of it sits the fear that actually keeps institutional investors awake. What if Oracle builds hundreds of billions of dollars of infrastructure and AI demand normalizes below the expectation before those assets ever earn back their cost of capital, and then empty GPU will not pay the interest? That is the real nightmare. Oracle is borrowing enormous sums to build massive AI capacity for one unprofitable customer, betting that demand will show up before the debt burden hits. That's the main fear driving the stock lower. Let's frame the valuation part. There are only two ways Oracle is worth buying today. Either management is right or the market is. There is very little in between. On the surface, the market looks too pessimistic. Oracle trades around 17x forward earnings and 9x earnings for 2029, down from 46x at its peak last year. For 30% plus growth, that's cheap. But that's the equity multiple. Add 150 billion of debt, and on an enterprise basis, Oracle is nowhere near as cheap as it looks. Leverage flatters the headline number. And here is the metric I care about most: the ROCE, return on capital employed, which is 9.4% for the last 12 months. In plain terms, do these data centers earn more than the money cost to build them? If yes, every borrowed billion creates value. If no, thin AI margins and rising borrowing cost, then Oracle will be destroying shareholder value with every billion it spends. Today, that answer is unproven. So here is the range. In the bear case, OpenAI stumbles, Oracle is cut to junk, free cash flow stays deep in the red, and the stock break its lows. In the base case, the backlog converts slowly and unevenly. Earnings land near guidance and the stock chops sideways until cash flow finally turns positive. In the bull case, OCI becomes the fourth hyperscaler, prepayments cover the debt, free cash flow inflects positive, and the stock re-rates violently higher. Notice how wide that spread is. Oracle is no longer trading like a mature software company. It's trading like a leveraged infrastructure project, one whose value depends on one of the largest AI investment cycle in history. The verdict: three reasons the market may be underestimating the Oracle. First, a backlog nearly 10 times revenue and almost fully pre-sold. Second, tens of billions in customer prepayments de-risking the spend. And the third, a valuation already collapsed from 46 times earning to 17. Three reasons market may be right. First, more than half that backlog riding on OpenAI. Second, over 150 billion in debt, a notch above junk. Third, free cash flow deep in the red with no confirmed date it turns positive. So what am I watching next quarter? And to be clear about how I would update my own view, if I see the backlog diversifying beyond OpenAI, free cash flow improving, and hard evidence that returns on these new data center exceed Oracle cost of capital, my confidence then rises significantly. Today, the market is not pricing certainty, it's pricing a probability distribution, and that is exactly why opinions on Oracle are so violently polarized. Disclaimer: in my view, given the big crash already happened, and now risk reward is skewed towards asymmetric positive return, and that's why I am a buyer here. But I would be actively tracking the business updates to reassess my position in future. If this video gave you the real Oracle debate, please subscribe and tell me below at these levels, is Oracle a buy, a trap, or wait? Disclaimer: this video is for educational purposes only and it is not meant for any financial advice. Do consult with your investment advisor before making any investment decisions.